Renewed optimism about the AI boom and confidence in a forthcoming Fed rate cut have lifted the markets this week. Our guest has some ideas for an investment playbook amid this bull market and geopolitical uncertainty. We're joined by Matt Orton, Chief Market Strategist at Raymond James. Matt, always great to see you. Thanks for joining us.
Great to see you too, Andrew.
What's the big theme for the market for you this week? What jumped out for you?
So I think what really jumps out to me is a continuation of last week. I think investors are realizing through all of the earnings we've had that this AI trade is not a bubble. We're seeing tangible earnings results, and I think the numbers we got from Oracle were just so incredibly strong in terms of showing us that there's a tangible pipeline, not just 1 or 2 years out, but 5+ years out with very visible bookings. And so one of the main messages I've given to clients this year is that we really should be leaning into any weakness that the market gives us with respect to this AI trade so that you can get exposure to that. And you don't just have to own these hyperscalers in order to get exposure. There are so many other companies down the value chain from electronic equipment within the industrial space that can also get you exposure to AI. But it's clear that this is the theme that you want to have exposure to, and that's been reaffirmed this week.
So your broad take on AI, though, say the Mag 7, just to use that as shorthand, it sounds like would you be waiting for pullbacks to buy into those huge names?
I would. I think my main message over this past year, especially after DeepSeek earlier in January, then we had the pullbacks in April after Liberation Day. Those were excellent opportunities to get exposure to these companies. And we've had a pretty strong run, Andrew, in the S&P 500 and the market overall. So it wouldn't be surprising before the end of the year if, say, you have a 3-5% pullback on the market. I'd use those downside opportunities to get exposure to some of those names. You should have exposure through a number of different stocks, but again, if you don't have exposure to the Mag 7, you probably want to add some. But for a lot of those other names, all of those ancillary AI trades across the industrial space, the utility space, within software, which has been an underperformer this year relative to semiconductors, wait for the market to give you a little bit of downside, because we will have some days that do that, and make sure you use those opportunistically to make sure that you have exposure to the AI theme going forward. But in addition to AI, there are other parts of this market that are working that are still relatively cheap, like small caps, looking down market cap. We were a little early into the small cap trade a couple of months ago, but it's worked out quite well. And small caps relative to large are still very, very undervalued. And there's a lot of high quality small cap names that are levered not only to AI, but just economic resiliency overall. And I'd look to add to those on any sort of weakness as well.
It's interesting. I mean, we're going to see a flood of IPOs touting their exposure to AI, it looks like, over the next year.
Oh, yeah, absolutely. I mean, the IPO market has been really strong, and that also speaks to the fact, again, you can get some exposure to the flurry through even financial companies. Financials, especially larger banks in the U.S. That have M&A businesses, are doing very, very well. And we heard from David Solomon earlier this week that they've done more IPOs, have been the lead book runner on more IPOs this week than they have done since 2021. So I think there's a lot of reasons to be enthusiastic about the IPO market, the M&A market going forward, especially with interest rates coming down. We're going to get a Fed cut next week from the Fed, and hope the policy.
Sorry, Matt. Did we lose you there, Matt? We lost you there for a sec, but we got you back, which is good. Gold. Now, you're broadly speaking, you think people should have a bit of gold in their portfolio?
I do, Andrew, and I think gold has detached from its traditional, just as a real rates play. We're seeing incredibly strong demand for gold coming from central banks. There's a lot more purchases that emerging market central banks still need to make. I think gold is very, very well. It's just broken out of a consolidation range. And so I'm very optimistic on gold. I think it's a ballast to portfolios. And you can also play it with a more pro risk on approach by owning gold miners, which over the longer term have vastly underperformed the hard commodity. So I still think there's a lot of ways investors can get exposure to gold for their portfolios, but I think it serves as a nice ballast to the AI trade. It helps reduce risk overall. So I'd be looking to add exposure there into portfolios.
Thank you very much, Matt. Matt Orton, Chief Market Strategist at Raymond James.